Hello, everybody. Welcome to our webinar today. I am so excited to get started. We have Mackie Hughes here from Live Oak Bank. He is a senior loan officer and vice president and is here today to tell us everything we need to know about financing our RAL homes. And I'm just so excited to learn and to listen. He has so much knowledge and experience for us today. So let's go ahead and get started. I don't want to take up any more of you guys' valuable time, and I'll hand it off to Mackie to get started with the presentation.
Hello, everyone. I guess this is Mackie Hughes over here at Live Oak Bank. And we've been working with Rala over the past 4 or 5 years, trying to figure out the best way to get everybody in the business, expand their business, and kind of create this great thing that's a service to, everybody's community and in the residential assisted living world. So, we've got a whole group here with a nationwide footprint that, looks to help folks like you, achieve ownership and help the community, like I said. So, a little bit about the bank. This bank is the largest small business lender with 7(a) loans in the country. We've grown the bank quite a bit over the past 10 and 12 years. And, we really focused on building a group around senior housing and senior care. So we do, the housing side, but also home care and home health care in our group too. So we've got about 5 or 6 lenders. We kind of cover all those different industries, and we've been able to have a pretty good run at it. Probably over the past 5 years when we really focused a group on it. Like I said, mainly what we do for this group is 7(a) loans, and we like the product, we like the small intimate environment, and I think that this particular concept is really taken off, as opposed to the sort of the big box facilities and more institutional, borrowers, which we do a decent amount of too. But I like the fact that this is an idea that's grown. It's proven. Our portfolio has done very well with the folks that we've helped that have done these residential style assisted living facilities, memory care as well. And we want to continue to grow that and continue to be a part of that success for years to come. So, like I said, they're getting more popular. People like staying in a smaller community. Some of these are boutique, which is great. There's always going to be a strong demand in the future for senior housing. So we're very, very of the opinion that it is a needs-based service, and we know that we're gonna do the best by our borrowers and their residents by doing the right loans for the right people, and so that's what we spend every day doing. We do a ton of construction. That has been a little bit less of what we've done over the past few years with COVID and supply chain, and I'll touch on that a little bit later throughout this presentation. But we understand what's going on. We stay close with our borrowers, and we understand, hey, there's been a huge issue with staffing. That has been the biggest thing. I go to these conferences, I talk to our borrowers, talk to our servicing folks. That has been the biggest issue to date since COVID and all the stimulus and all that stuff. So the good news is, over the past week or so, we kind of evaluate our portfolio, and we've seen an uptick in, the ability for owner operators to, retain caregivers, hire more caregivers, getting it back to sort of a pre-COVID, state. And so while the first quarter of, 2022 wasn't great, in that regard, since then it's really picked up. So people are going back to work, and inflation's coming down, and we're starting to see that in real numbers, in real performance. So that's a really big positive. The other challenge, like I noted before, has been supply chain, construction and that whole lot. Now, you know, that is still sort of an interesting aspect to kind of try to get our hands on. Some places, some parts of the country, you know, we're seeing a normal normalization of those costs and timeline and all that. In other parts, other states, you know, they're still lagging pretty far behind. So, you know, I'd like to get everything back to where it was before, but those are the types of deals that we're very cognizant of. And I think that, you know, that's still something that's big on our radar when we're underwriting these some of the construction stuff. The good thing about this particular industry, though, is, you know, if you're doing a smaller, maybe an outfit of a residential, you know, home, you know, there's less in a lot of cases less of an issue than if you were doing a ground up. Now the ground ups have their you know, a lot of positives, right? Brand new, you can kind of set up the facility how you like, but they do come with more front end work and trying to figure out what materials costs are going to be and sort of when we can feel comfortable about the facility breaking even and how to underwrite around that. And then the thing that's not included on the side is really the big thing that most people are worried about, and I've been fielding calls from, you know, more hours of the day than I want about interest rate. You know, rates are rising, you know, and that's partly a good thing to combat inflation, but also, you know, does this make sense at a certain rate when we do our pro formas, aka projections? Does it make sense, you know, with the budget that we have, you know, as opposed to when we were sitting at, you know, we were sitting down looking at rates about 6 months ago. So, you know, those are headwinds in a way, but in an also sort of another, you know, component to how we underwrite. We always shock the rate. We always, you know, okay, hey, what if it goes crazy, which it's kind of done. Do these deals make sense? And so we already kind of build that into the way we look at these loans. And, you know, just because the base rates are going up doesn't mean the spreads are going to go down for banks, right? Banks still have to make money, and you know, it has to make sense for all the parties involved. So what I've noticed, though, for this bank and all of our other competitors and banks throughout the country, you know, they're shifting more towards, you know, a variable rate. Variable rates are always very common in construction and startup deals, but I even see that more in acquisitions. You know, you'll get a better rate if it's a variable, very skinny spread if it's variable, and then the longer you fix the rate, obviously the rate's going to go up. So you know, you kind of see that in extremes right now. You know, they'll level off. You know, what we kind of have seen and what we're forecasting is kind of a level off in the winter. But you know, you never know. But those are things that people are very vocal about. They're worried about it. We hear it every single day, and you know, we just, you know, like I said, we underwrite to kind of anticipate certain things like that. And you know, we've done a pretty good job at it. You know, we've got less than a 1% default bank wide, less than that even in our senior care vertical. So you know, that is part of underwriting the correct way, but also because we underwrite, service, close, we do everything in-house. So, you know, we see exactly what our borrowers are doing, you know, hey, you know, and we try to get in front of any sort of, you know, issues they may have. You know, they might have a lot of attrition, you know, folks move on to skilled nursing or whatnot, and they need to fill beds, and hey, maybe that happens all at once. And you know, we're here to, you know, provide sort of a, you know, partnership there to, hey, maybe we do a couple of months of deferment, just, you know, maybe we help, you know, help in that capacity to sort of, hey, you know, we understand certain things like this happen in the industry. We want to get in front of it, and what helps us to do that is we keep all of our servicing in-house. So so that's how we've been able to navigate, you know, the last challenging few years. And I'm feeling really good. I feel like that we're really kind of getting to the end of that kind of unknown part of financing in this industry. And I think that this particular product will continue to grow in popularity, throughout the country. All right, so let's get into a little bit about how we finance these, what products we use. So for residential assisted living, we mainly 99.9% of the time use SBA 7A loans. That's the one on the left. The reason being is it kind of checks off all those X marks there. You can finance pretty much anything and everything under the sun when it comes to your projects, ground up, acquisition, expansion, partner, your FF&E, all this stuff. And I think the most important thing about it is we can finance in that 7A portion your reserves or construction reserves, which essentially pays the loan as you build your facility or upfit your home. And then it also covers your lease up reserves or ramp up reserves. So as you fill up with your residents until you hit a certain point, the loan is able to have reserves in it to cover that shortfall, right? And so that's the biggest part. And all of these things are financed in one loan, and they are all put on a fully amortized 25 years, which means you don't have a balloon payment, and you don't have any sort of performance covenant. So you don't have to hit a certain number of residents at a certain time, or any sort of DTI or any sort of weird ratios that a lot of conventional loans require. And so that in a way kind of keeps keeps all that pressure away. And as long as you're making your payments, you're not in default of these loans. So that's 7A. You can kind of do it all at once, and we do all that stuff in-house, and so that makes it quicker. And I'll touch on that a little bit later. And then you've got SBA 504, which is a great product as well. With SBA though, you're kind of limited to what you can finance with respect to the real estate. You can only finance stuff that's going directly towards the real estate project. So you would not be able to finance in a 504 those reserves that I spoke about that kind of get you from the shortfall to when your business is breaking even, making money. So that's an important thing to think about, because a lot of people, hey, what's the difference? And I think 504, they think it's a lower rate. Okay, in certain ways it is, but you can only finance a certain portion of the deal. So you're going to have to come in with more money. And so does that make sense? And so those are the discussions that we're happy to have when it relates to the difference between those two particular products. And then the third product that we use once in a while, we do more and more of it, and we actually are the largest B&I lender for USDA in the country, is USDA is B&I. So that it kind of covers your tertiary or sort of rural market offerings, and those are those deals take a lot longer, though you do get a longer term, which means your payments are lower, and the bank likes them because they get a larger guarantee. So a lot of times those deals don't make a ton of sense because everyone wants to close their deal as quickly as they can. But in certain cases, when you've got borrowers that maybe already own the land and they have time to kind of go through that process, maybe it makes sense for them. But most of the time we're doing 7As. So talking about what we can or cannot finance, mainly these programs are geared towards assisted living, memory care. You can do some skilled nursing with them, obviously, and then you're able to do some portion of these with independent living. But the focus that we have and the expertise that we have is really sort of centered around assisted living, memory care. That's the majority of the type of acuity that we're able to get approved, and quite frankly, there's so much of it that we haven't really had to extend into other levels. That we have done a few skilled nursing facilities and some independent living, but like I said, this is our day-to-day bread and butter is assisted living, memory care. You'll see on that next little green portion there, there's sort of that size limit. Now 7A is it's really, most banks really will only go to about 5 million in debt. We're able to go higher than that because we have a comfort level with this type of product and in the industry. So I think your total project size for what we do 7A would be 12 million. I think of that you're probably looking at $8 million max in debt. The majority of what we do for residential assisted living really kind of falls into probably between, you know, 1.5 to $5 million in debt. That's just sort of been what the size has been for these. Now the 504, like I said, it's a great product for doing larger facilities. You know, maybe you're doing a 40, 60 bed. That's really getting away from, you know, what's great about residential assisted living, but we do a decent amount of those. And then similar, you can see on the USDA side. So when we look at, you know, how much is it gonna, you know, our leverage gonna be, right? For 7A, you can do 90% of the deal, but that's really more for like acquisitions. And you'll see in the next slide, we'll break that out a little bit more. You have 25-year AM, 504, 25-year AM, and 30-year AM for USDA. Those are all fully amortizing. There are no balloons. And then pricing, you know, we'll get into that a little bit later. But generally for construction loans, they're going to be variably priced. And for acquisitions, we can do a fixed option, usually 3, 5, 7 years, depending on sort of the strength of the deal, strength of the guarantors in the deal, and sort of the profile of what you're going for. So the prepayment penalties, they're really pretty easy for F7A. It's only 3 years. It's 5% in the first year, 3% in the second year, and 1% in the third. I would remind everyone that sort of timeline, that clock, I guess, that the timer starts day of close. So if you're doing a construction project, you know, it's going to take you probably, you know, the better part of a year to outfit a home, or, you know, even a year and a half maybe to do a ground up. And so by the time you're filled up, you know, you're really not, you're already into year 3, and you're really, you know, ready to, you know, if you wanted to refinance it, you're not going to be paying a prepayment penalty, to be quite honest. 504, the larger deals are going to have a larger prepayment penalty. The bank loan is probably going to be a 5-year, and there's a second portion of that that's going to be a 10-year, you know, for the SBA. So there's 2 loans in that, and, but we don't do a lot of those with this type. So, you know, I won't waste too much time on that. The eligibility on what makes sense. So we're basically looking at the owner operator profile. We're not looking at passive investors, and we are doing, you know, all for profit. You know, there are no ways to do nonprofit with these SBA loans, but there are other options that we do have at the bank to do nonprofits, but mainly we're doing for-profit loans. So I always like this slide. You know, you think, all right, well, here are all these loan products. That's great. You guys do like a lot of lending throughout the country. How do you look at these deals, and how do you underwrite them? How do you feel comfortable doing them? And, you know, this is sort of a slide that, you know, people with lending backgrounds probably can remember. It's really the 5 C's of credit. You know, what's important to us, you know, and what's important to our underwriting, you know, standards is really going to be, you know, hey, what's your cash flow? How's your credit look? What are we lending against, which is collateral? How much money do you have, which is the capital to put down into the deal? And all those things together, if we check all 5 of those boxes, then, you know, we're feeling pretty good about, you know, funding a loan for somebody that's coming through the door. So, but I think for Live Oak, the most important of all of them is really character, and especially for an industry like this. You know, we are very conservative when it comes to, you know, this type of industry, because you're taking care of, you know, someone's loved ones. You've got to stay on it. You've got to stay on it with licensing in the state. You've got to be, you know, very attentive, and you have to be involved in the business, right? So, you know, being there is everything to us. Now, do you have to be there every single day? No, but you have to have a system that, you know, makes sense for someone to help in the facility. You need to be, you know, aware of everything that's going on, and I think that character is a huge part about what we do. And we go and meet every single person that we lend money to, no matter where they are in the country. Shake their hand, make sure, hey, you know, this is the right person, you know, for this opportunity. And you know, a lot of times it works out great. Sometimes we meet people, and, you know, sometimes it, you know, it doesn't really feel right. So, you know, we pass on it. So let's think back a little bit back into that. You know, equity into the deal, right? Cash into the deal. This is one of the most asked questions that I get, for doing, sort of these types of deals. Now, we know SBA is great, right? We know we can go do a larger deal with lower leverage than you would a conventional deal, right? The SBA, their SOP, the sort of the guidelines of how they want you to lend, the rules really of how they want you to lend, allow for you to do 90% financing. Now they say that, okay, well, I want to do a startup, and then the SBA says I can do 90% financing, so you got to give me 90% financing. Well, that's not really the case. If you're doing a startup, it's a riskier deal, and the SBA really, if they audit the file, they're going to say, hey, look, I'm going to have you should have had this borrower bring in more cash to the deal if it didn't work out, right? So really kind of interpreting that and knowing what they really mean. Startups, you're looking at least 20% into the deal. And when I say 20%, that's just not 20% of the loan amount. That's the whole deal added together. What's your total project cost with all your reserves, your closing cost, all that kind of stuff, and then 20% of that. And you'll notice that at that, just putting in 20%, great, you get to that threshold. We also want you to have some what we call post-injection liquidity. We're not going to take all your cash for this deal. We're not going to put you in that sort of cash poor position. And so, we want to see a certain amount of post-injection liquidity, and that's really based off of everyone's individual needs. So we'll see what your personal credit profile is, what are your monthly obligations, and we do a deal by deal, analysis on that to figure out, hey, you're ready to go, you look great, or hey, maybe you need to save up a little bit more, or bring in a stronger partner that has some liquid. So for the acquisition side, probably 10 to 15%. Usually we can get to 10% down as long as cash flow works. And like this slide says, we're not really interested in doing a ton of turnaround facilities, right? If it's not working right now, it's probably not going to work after you take it over. A lot of people think that that's the case, but we've learned otherwise. There's ways to get around it. If you're an existing operator that has a few of them, and that you can kind of replicate your brand on something that needs a little bit of TLC, maybe we get behind it. But in general, we're hesitant to do that. It's more difficult to get our credit folks on board with kind of a turnaround, even right now. And then, if you really are humming along, you're making a lot of, you're making a lot of money, doing a lot of great stuff. You got a few of these things, and you want to expand into your third or fourth. We can actually do 100% financing on that. We just take, the other companies or entities that you have and put them as co-borrowers, and that way you don't bring anything to the deal. So that's something that exists, and we utilize that for the right folks when they're in the right time of growth. And so, that's what actually, why SBA is great, because all of these, even the 20% down, is better than you'll get from a sort of a regular bank loan, commercial loan. Okay, so I kind of touched on this. People want to be involved, or we want people to be involved, and we want people to be, around their facilities. And so we kind of frown upon remote ownership. We know that in some cases it exists. We know people need to make money outside of these, at least for their first couple. So we understand that is a component to this, but we just need to demonstrate, and feel good about your business plan, in particular for you and how you're going to run your facilities to get comfortable, right? It's hard for us to get comfortable when someone living in Los Angeles is trying to manage, a facility in Virginia or Rhode Island, right? That's something that's difficult. Generally when you have remote managers, there's going to be another partner that's kind of boots on the ground, that's local to that. And so, be mindful of that when you're looking at opportunities, at least for, what we look at, and know that the SBA, really requires us to show that, hey, look, there's really an active role in the management operations day to day. And people, with all this, remote working and Zoom, all these great things, that's possible. But I don't think anything that's going to be a substitute for physically being in that location. People understanding where they're putting their loved ones. All those things need to be, um, carefully thought out, right? If you're going to try to do a remote ownership sort of profile. Okay, so I kind of touched on this. This is sort of normal SBA stuff. Here's kind of a deal profile. We get to lend to this stuff throughout the country because we do get a guarantee from the government if we underwrite the loans correctly and they think that we made a prudent decision. If they don't think that, then we don't get a guarantee. I'd say for us, I like deals that are kind of 7 million or less. We'll do kind of 7 to 10 million, but like I said, most of what we do is between 2 to 5 million, 2 to 4.5 million. I think that the higher you go over that 5 million mark is where we lose the guarantee, right? So we know we're going to get a certain guarantee at 5 million. If we go over that, we might ask for you to bring in more cash because we're putting our own balance sheet or essentially our own exposure out there. All these loans are the bank's money. The SBA doesn't just print out money, or give you allotment of money. We lend our own money and we maybe get a guarantee in a workout situation, but it's the higher you go, the more cash you're going to have to bring in above that guarantee portion. This is kind of a slide that sort of kind of notes about what we're looking at, right? Owner operator, not a passive investor, must be actively engaged in your business. You're able to have investors at minority percentages, maybe minority equity ownership stakes. Hey, I'd like to invest in your residential assisted living project, but I don't want to guarantee the loan. All these loans are, recourse loans. Which means you guarantee the loan, personally guarantee the loan for anybody that has ownership of 20% or more in the borrowing entities. So, we have people that, have 18 or 19% ownership. They're the sort of the minority partner. They write a check, and then the guy that, has 81% signs on the loan. I see that a lot, but, that's something that is important to note when you're kind of looking at, hey, who wants to be involved? At what status do they want to be involved in these projects? Just know that that's the threshold. Anybody 20% or more must guarantee the loan, and it goes to a warm body. You can't just create a couple entities and say, well, these entities are this. No, for SBA, they're going to go to a person. You can't get around it. So we like to see good personal credit, right? We're doing recourse loans. We're looking at all this profiles on your personal financial statement. For Live Oak, we really don't do deals or anybody's had any past bankruptcies. Most banks will give you a 10-year reset. We generally will not do that. It has to be a very compelling deal for us to get somebody approved with a past bankruptcy. We do criminal background checks, all the regular stuff. I mean, you would get for any sort of loan really that's government backed. And then, SBA, you can only lend to certain industries. Luckily, this industry is a eligible industry. The other thing I get questions out a lot is like, hey, we own a business, we want to take an SBA loan out and cash out. They do not let you cash out on SBA loans. You generally have to keep the cash in the business. You can refinance your loan or your hard money loan with an SBA, but they're not gonna do a cash out structure on its face. All right, so we know all this stuff about SBA. We know kind of how we look at things, what leverage there is, rate, all that kind of stuff. What do you all need to do to get a term sheet from us and move forward with your project? It's a lot just to get to the point of having this stuff, right? And that's why I'm glad that everybody's involved with learning about this and what's needed with Raul and all the great other folks and vendors that are there. For the bank, you really have to have a buttoned up package, right? We can't just say, hey, look, Mr. Smith, we looked at your forms. We don't know where your assisted living is going to go. We approve you for $1 million. Go do whatever you want. We actually have to underwrite the deal specifically. So especially in construction, right? We need a physical address. And the reason we need a physical address is because we do a market study, right? We get a market study. We make sure that there's demand in that particular market, sub-market, and make sure that, hey, no permits are pulled to, build a big box, even though, hey, and a lot of times they'll say, well, we like this product better. It's even better when there's a big box across the street. I understand that, but the bank's going to want to have a physical address, and they want to know, hey, this is where we're building it. This is what we need. Business plan, super important. I think that if you're doing a startup, you're doing construction, that's asking the bank to put up, to mitigate a lot of risk and structure around a lot of risk. And so the better the business plan, the more information we have on, and the more, on your experience and what your plans are and how you're going to run it, where you're going to get your referrals from. All those things are very important. And I think, the deals that are the construction deals and the startup deals, really dig into that business plan, and make it something that would feel like the bank has, okay, that's reasonable. I think we can get behind it. And I think, you guys have a little bit of resource there with the program you're in, but, tailor it to yourself, tailor it to your market. Say, hey, look, we have these many contacts at, the local hospital, or we know that there's another fellow residential assisted living owner that's got a huge wait list and they need to place people. Those kind of things. I think those things help. We do require month-to-month projections. We call it pro forma, and that helps us kind of figure out, all right, how long is it going to take for this thing to fill up? What's your, what are you charging your resident per month? What are your food costs? What do those margins look like? And your labor costs is obviously very important. So go through that and really kind of be thoughtful on what is it really going to take month to month to run this facility, and then we can get a pretty good gauge on whether that makes sense for that market. We look at these all the time. We have a breadth of material throughout our existing portfolio to say, hey, look, maybe we should tweak the food cost a little bit. Maybe you're charging yourself too much here. Maybe there's some ways we can adjust the projections, and we can work through that together. But those are very important. Construction estimates. Gosh, the the hard thing is, right, you get your plans, your permitting, your site work, you get all these different kind of cost line items. Really, it's just hard to figure out, all right, we got a set of plans, can't really go out and get a bid. Some GCs want you to go further down the line with the banks. Some banks want you to go further down the line with GCs. It's really an educated guess, to be honest with you. And we always err on the side of being very conservative on those. We want to have cost estimates that are realistic, but we don't want to skim them up too much to where if there's some overrun, we're in a bad situation. We have to go get a reapproval for an increase on the deal. It's just not the way to do it. So the closest we can get to construction estimates, that's important. We do require 10% contingency on hard cost. And the more detailed that your construction budget is, the better and easier it is going to be for us to, put that into our use of proceeds, figure out what we charge you on contingency, what we're not going to charge on contingency, and all that kind of stuff is important. And I think the more detailed you can be on that, the easier it is for you. I get stuff where people have, 4 or 5 line items and that's it. That's not realistic. That's not a realistic construction budget. I think, talking with somebody that understands, hey, this is what we really would, this was what the budget should really look like, a true GC. And by the way, we do qualify our general contractors. They have to be on the up and up, so that we're not putting somebody in a bad position with or somebody that's not as experienced as they should be to be doing this stuff. Market analysis, I touched on that. We do need to get a feasibility study, third party, right? And that's something we can do in an appraisal or separately on the beginning of looking at these projects. Use of proceeds, like I touched on, that's part of your construction budget, but also other things like, hey, this is how much my marketing is going to cost. This is how much signage is going to cost, stuff like that. And then, we send out a couple forms that sort of go through and give you a little guidance on how to do that when we do that analysis and get a package together. So that would be what you need for getting a term sheet from us on the construction side. Acquisition, a little bit faster, a little bit easier. You already have existing cash flow on a business, right? Last 3 years of tax returns, year-to-date profit and loss and balance sheet. Like to see a census. I like to see a payroll breakdown. Most of this stuff's private pay, so that's pretty easy. And then sort of the forms we have from Live Oak sort of your loan application forms, which is about 4 or 5 forms you fill out. And then, we need the personal stuff, right? Because we're underwriting these as recourse loans, personal guarantors. So personal financial statements, last 3 years of your personal tax returns, and all that fun stuff. So, and we'll pull credit as well. That's sort of a recap there, of the term sheets, a little bit bigger font. So timing, right? So if we're doing, let's call this what we do most of the time, 7A loans, right? So we're trying to get from 90 days from start to finish. What that looks like is generally if you got it, your package together, you're ready to go, you send it in. It takes about a day or two to turn around a term sheet if we like the deal. Then we go and you sign the term sheet, we go into underwriting. Underwriting takes about 2 weeks. And then you get approval from the bank. That approval is a binding approval from the bank to fund the loan. And we go, if you like that, you sign that, then we go straight into closing. It's usually 7 weeks. So your commitment that's binding from the bank lasts 90 days. Sometimes closing lasts a little bit longer, we get a reapproval. But if it starts lasting longer and longer and longer, the bank starts getting a little bit more, uncomfortable, probably a little bit more anxious about the deal. So, I think having everything lined up, before we go into the underwriting stage and having stuff ready for everybody to run with is important, because we don't want to have to go back to reapproval, for a year, over and over again every 90 days. And this is a great part. Commercial loans do take a lot longer than residential loans, right? And that's one of the biggest issues with this industry. You see a house that might look like, hey, this is going to be a perfect location, perfect little neighborhood. There's no restrictions against it, but the seller wants to close in 30 days. Well, a commercial loan is just not going to be able to achieve that. I see a lot of folks, go get, quicker money, whether that's in the form of a residential loan or a hard money loan to go ahead and take the house off the market. I can't advise people on what to do or how to do it that way, but what I will say is, in order for us to take out that loan, it can't be over 25-year AM. So I usually see people get a 15 to 20-year loan, residential loan, so that the SBA is able to take it out. Because if you get a 30-year mortgage, it's really tough for us to justify taking that out with a commercial loan with the SBA program. So keep that in mind. That's an important aspect. Now we've had mixed reviews when we go to SBA and ask them about that. But just to be safe, I would keep it under 25 years on your mortgage. All right, so a little bit more on interest rate. All of those factors there in the slide matter when we look at interest rate. If the deal is riskier, the bank's going to charge you more in spread. We price these deals over Wall Street Journal Prime, so it's usually like prime plus 2 1/4, right? Prime plus whatever. If we do a variable, it's going to be a lot lower than that. If we do a fixed, it might be higher than that. It's all kind of specific to each deal, but it's a spread over Wall Street Journal Prime, it depends. If you're bringing a little bit extra cash, you're going to get a better rate. If you're really got great personal credit, great liquidity, you're going to get a better rate. If you're struggling to make this happen and it's a riskier deal, you're not going to get a better rate, and you might not get approved. So, we're a little bit different, very different from other banks I've worked with. In that, we've got a pretty tailored approach, especially to these types of deals with residential assisted living. Everybody in the chain of your loan life is going to know the margins. They're going to know what to look for. They're going to know how to underwrite these, and also we're going to help you through construction. We do all our construction in-house, and we all pretty much work in the same campus. So, we're here. We're not farming out any of the important things that go along with the process of getting your project complete. And I think that this model is unique to other banks throughout the country, and it helps us, have sound credit, but also helps the borrower get somewhere quicker and achieve success. And I think having a hands-on approach is important when we're doing these types of deals. No matter where they are in the country, we're there to help you. This is a fun little slide. I always say, people kind of, say, oh, SBA takes forever, or they do all that kind of stuff, but there are, positives to it. Keep some cash in your pocket. You don't have a balloon, and you'll be able to kind of expand with less cash than you did on your first one. So I think that all that being said, it's a lot of information. It's kind of a funky way. The SBA is very different from a regular loan. The rules are really designed to protect the owner operator like yourselves, from having to go put all your life savings into a deal and have covenants and balloon payments and all that. So it does help. This is a popular product for a reason, and the flexibility of being able to do construction with it and put everything in the same loan to save you money on fees. All that stuff's very important. And we've had a lot of success, in lending to this and lending to the right people in senior housing. But yeah, there, a lot of this, we say no a lot too, but it's been a pretty good ride, and I'm proud of all of our folks in our portfolio, and we do get a lot of referrals from our existing customers, and that goes to show you that they've got to where they needed to be and kind of achieve the American dream there. And that's what we're here to do. We're here to be America's small business bank, and we're well on our way to do that. And we're excited to be a part of kind of your growth, and we've got a great team to help you guys achieve that. So I think that's enough about for me talking. I think we're going to open up for 10 minutes of questions. Jamie?
Yeah, absolutely. Thank you so much. I have plenty of questions that you guys have been submitting throughout the presentation. So thanks for your questions, and we're going to try to get to all of them. So the first one, we have a question that says, is Live Oak Bank a direct lender?
Yeah, so we are a bank. We lend our own money. So yeah, we aren't going through a different bank. We're not owned by a different bank. We went public in 2015, and we have no plans in selling the bank. We're in the mindset of being the bank for SBA throughout the country.
Awesome. All right, our next one is, I understand the 7A loan can be used for construction loans. Does it also cover the land purchase?
Yes.
Awesome. Simple, easy. Okay, the next one is, what's the options for collateral?
So collateral is an interesting point. So we're lending here to a facility, right? A residential care facility. So the collateral essentially is that, we don't tend to reach out to get additional collateral, right? An additional collateral usually consists of a secondary lien on a personal residence or a rental property. And the only reason that we would reach out and take a secondary lien would be if your appraisal didn't come in to cover the loan, right? So we will discount that appraised value to a certain degree, and as long as that covers it, we're only going to take a lien on the residential assisted living facility. But if that comes in low, SBA requires us to take usually a secondary lien on additional collateral, outside collateral, if there's equity in it.
Awesome. All right, our next one is, please describe how you handle the change of ownership of the business and license when purchasing an existing ALR.
So this is state specific, right? Some states do require you to have the license transfer. Some let you close and be under a power of attorney. My thought is that we try to structure with our closing partners and our legal counsel a very clear transfer of ownership. And sometimes if there can't be right at close, if the state requires there to be a transfer of ownership and then you get to apply for the license, generally there'll be some sort of factor, right? There'll be a seller note or something to where, there's a certain tool or mechanism to where we feel comfortable closing without the transfer of licensure. And that is something that is unique to every deal, depending on which state we lend in. And I wish we could do it. I wish in all deals we could do it before we close.
Mm.
And those are the easiest deals. But if we can't, we find ways to make it make sense for everybody.
Right, right. Okay, great. The next one is describe how you handle escrow arrangements where there are changes demanded by the state prior to change of ownership. And you gave an example, like if you have a sprinkler system upgrade and it could cost up to 200,000 or more and must be completed prior to license owner change.
So generally what we'll do is we will budget that upfit into our loan, right? We manage our construction loans say it's just a straight acquisition, and in order to get licensing or whatever we need to do to get the property sprinkled, we will multi-disperse the loan, right? So we'll manage that upfit in our construction department, make sure that's all good to go, and we'll be in contact with all parties throughout the whole process. So that's sort of how we all construction deals and all of our draws and everything's managed here. So we're going to watch every part of this thing get built, and we're going to be in constant contact with the subs, the GCs, the licensing entities throughout the states. We stay on top of all that.
Great. All right. Next one is how do you handle FGI requirements during the purchase of existing ALR?
I didn't hear you on that one.
Oh, that's okay. It says describe how you handle FGI requirements during the purchase of an existing ALR.
Give me the acronym FGI.
Okay, that's from Brian. So Brian, if you want to submit in the question bank what the acronym stands for, I will come and circle back around to that. Oh wait, no, that's time. Okay. So we'll just skip to the next one. We'll come back. What happens if you're the founder of the RAL and you own the property, but you have a bankruptcy in the last 10 years? What are possible options?
Well, we wouldn't be able to move forward on it, but there might be other lenders that would. When you're looking at past bankruptcies and you file for bankruptcy relief, it'll be something that will relate to the actual story, right? So if it was a story that was compelling, you had no other issues, prior to that and since that time, that would be the line of question, sort of the line of thought when you approach lenders. We are flat no, and that is conservative. Other lenders do work with you a little bit, but I would think getting the story, having someone listen to your story, getting them comfortable with how you've done lately and what you plan on doing moving forward, and then also your credit profile. Like if you've got, you've been successful since, you saved your money, you've been on, up to date on all your payments, all that kind of stuff. That stuff matters, but it's still a process, right?
Yeah. Okay. All right. So circling back to the how do you handle FGI requirements? It's Facilities Guidelines Institute during the purchase of an existing ALR.
Facility guidance. So I'm not familiar with that, but if you are an existing owner or founder and you're I'm assuming that if they already own it, what is the second part of the question they're trying to do?
What's the requirements during the purchase of an existing ALR on how you handle it with the FGI requirements?
Yeah, so I'll try to answer this the best I can. So if you own one and you're purchasing another one that's existing, there are state by state, there are different requirements, in licensure. We look at all of it. We look at the performance of that facility year over year, look at the cash flow. We look at your pair sources. We make sure that the seller's in good standing. We understand that there are complaints, right? That's part
Mhm.
of the sort of the nature of senior housing. But as far as any kind of licensing requirements, we're going to make sure that the seller did well. There aren't any liabilities that'll transfer. Usually it won't because they're always asset purchases.
Mhm.
And we'll make sure that there's not sort of a bad reputation for the facility, right? The last thing
Mhm.
you want to do is step into a facility that doesn't look good, bad Google reviews. That's sort of the turnaround kind of facilities that I noted before. We don't really want to be involved in. We're very conservative on how we underwrite it because it's very important to
Yeah.
put people in a, a respectable, safe place. And anything that's against that or anything that just doesn't feel right, we're just going to step away
Mhm.
from that deal.
Okay. Awesome. All right. The next one is, what is the perfect personal FICO score that Live Oak Bank is looking for?
So we do, and that's a good question. So we look at, we probably won't do any score under 675, maybe 650. That's about as low as you go.
Mhm.
Most people are, but then you could have a score, say you've got a 750, but you've got a ton of liabilities. Like you're always paying on time, so your credit score is good, but you've got a ton of obligations. So it's really not as much about the score as it is about what is your monthly obligation? How much debt do you have out there? Can you cover this debt outside this deal?
Mhm.
That's the more important component to the analysis rather than just a flat credit score. Like, you know, you could have an 800 credit score, 750 credit score, but you're barely making it month to month, right? So the credit score is not going to look at your personal liquidity. It's just going to look at how you kept up with paying stuff. So that we combine the personal financial statement and the credit score, and then we come up with an analysis on that. So there's no perfect credit score, but I would say if you're sitting below 675, 650, it's probably not the best.
Okay. Good to know. Awesome. All right. The next one is, how do you lock a residential home that's on sale for 90-day closing? Would that be too long for a buyer to hold? What is the general practice here?
So the the question I think just surrounding what I'm saying is it'll be 90 days for you to get a commercial loan closed.
Hmm.
It would be between you and the seller of the residence whether they're okay with a 90-day due diligence period. It doesn't really, um, it's not really something that I have any part in. I just see it how people have been able to do it in the past. They usually get a residential mortgage and then they'll refinance that residential mortgage into a commercial loan so that they'll be able to do construction and finance all the stuff that goes in the business.
Hmm.
But they take a risk doing that, right? And because we require market studies and all that. If a market study came in where it wasn't favorable, then we're not going to do the commercial loan, and so they'll be stuck with this residence on a residential loan, which it's not the worst thing. They could just sell the house or keep it rented out. But I really rarely ever see market studies come in unfavorable.
Hmm.
Um, just a few of them over the past 5 or 6 years. I mean, most of this is needed, right? So that's why we're lending in the industry.
Right. Next one says, I act as a landlord for several residential senior living houses. Do you have programs to help people like me finance or acquire properties to help more people start businesses?
No, you're not. As a landlord, you're not an owner operator, right? You're strictly a passive kind of. You're collecting money. We only lend to people that are owner operators. So the people that are renting from you could get a loan from Live Oak Bank to purchase their respective facility. But
Mhm.
as far as lending to a landlord, that's not something that Live Oak does. Other lenders do. But SBA does not allow you to do that, so we don't lend in that capacity.
Okay. All right. Will you finance the purchase of a building on the East Coast? And if so, what is the loan ratio to the liquidity rate ratio?
Right. So yeah, we lend all over the country. I mean, I literally did 2 deals in Alaska. We've done in Puerto Rico and every single state. So we'll go anywhere. Um, that we can. There is no set debt to income or any sort of ratio for SBA loans, which allows us to be flexible, right? So we pretty much underwrite off of cash flow. If we feel that and the business that you're acquiring can cash flow the debt, that's all we're really worried about. Yeah, it's nice to have a certain amount of value in the collateral. It doesn't really matter for the program, right? The program is designed to help people that are small business owners. So I would say that's the majority of how we underwrite it. And then when you say, well, what if there's no cash flow and we're doing a startup? Well, we still look at it from a cash flow perspective. We look at, all right, how long is it going to take for the business to start going and generate enough cash flow to cover the loan? And we'll just do that analysis on a projected basis. And then the other side of that is, we look at a certain debt service coverage ratio. Now, all these are pretty much private pay. So you have a minimum debt service coverage ratio for cash flow of 1.25 times. So just keep that in mind. We like to see them at 1.3, 1.5, but we'll do a deal at 1.25 times. I like having a little bit more cushion there, obviously for rate hikes and little things like that. But yeah, it's really more cash flow. We're not collateral lenders. We can still do a deal with even no collateral. If you just wanted to purchase the business operations of a business or a home care business or something, we do that on a shorter terms. But yeah, there's no set ratios there.
Okay, great. All right, we got like a couple minutes left, so I'm trying to get through you guys' questions. So we'll do a couple more here. The next one is, do you use the seller's tax return to get approved for the SBA loan?
So if, in this case, I think they're referring to a straight up business acquisition or an acquisition of an assisted living facility. Yes, we will look at the last 3 years of the seller's business tax returns. Most of the time, those will be two entities. There'll be a OpCo and a PropCo, operations and the real estate holding company. We'll get both of those. We'll spread them, and then we'll get a year-to-date, right, interims. And then if all that looks good, cash flow works at the price and the leverage that you want, we'll issue a term sheet, assuming everything looks good on the personal side. So yes, we do require, and the reason why we require tax returns is because we can verify those tax returns with the IRS. You can't verify interims for the most part. And for a lot of these are smaller businesses. We're not doing a big audit or anything like that. We're going off tax returns. So if the seller's not paying taxes, they don't want to show income, then we can't, we're not going to be able to rely on stuff we don't know about. So yes, we do require seller's tax returns.
Okay, awesome. We'll do a couple more. Okay, who holds mortgage of the house? Would that be Live Oak Bank or any other lender?
Yeah, well, so we would be the lender in first position. There will be no other lenders. We do not participate in these size deals.
Okay. Then how much % of ownership should be given to the local operator? What is recommended so bank is happy?
That's a deal by deal thing, right? That's about you. That's not something I can comment on.
Okay.
These deals, you need to figure out, all right, who wants to be in the deal, and you come with us with a final structure of ownership, and then we can't tell you who to partner with or who not to partner with.
Right. Okay, awesome. Well, thank you guys so much for all of these awesome questions. This webinar was recorded, so you will get the recording emailed to you tomorrow. And just in case you want to look back over this information, you have that there for you. I went ahead and put Mackie's information in the chat for you. If you want to reach out to him, if you want to work with the bank, then that information is there for you guys. But thank you so much for joining us today, and we will see you on the next one. Thank you, Mackie, for joining us. We appreciate your time, and we'll see you on the next one.
Thank you.
Yeah, thank you. Yeah, have a good day, everybody.